Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome to Something More with Chris Boyd. I'm Chris Boyd. I'm here with Jeff Perry. We are both of the AMR team at Wealth Enhancement, and glad to have you with us. We have a special guest today. We have Joe Gaj, the insurance guy, who's going to join us. And
He's
Joe,
never heard that before, Chris.
I'm sure it's all the time.
Oh, yeah.
Joe, we're glad to have you here, and we'll talk a little bit about some insurance-related issues. Maybe we just start off with we can begin by just an introduction to you and where you fit into the Wealth Enhancement organization, so we can disclose all that to our listeners.
Yeah, sure. So Joe Gaj, Director of Insurance here at Wealth Enhancement. We are part of the centralized service department. So insurance, which includes life, disability, long-term care, and now a newly minted annuity desk as well. We handle all things insurance from that personal aspect for our clients. Advisors are encouraged to use centralized services, which isn't just insurance. It expands to retirement planning. It includes also our tax department, our advanced planning team. We have group benefits, obviously pension, 401k, the retirement planning consultants. What else am I missing? High net worth, business strategies. So quite a few centralized services that we offer here at Wealth Enhancement. My area of specialty is working with individuals and business owners on insurance planning strategies. So again, life, disability, long-term care, annuities. And, we're here to obviously support our advisors and put best product and solutions in front of our clients here at Wealth Enhancement.
So it's worth talking about for a second with our team. We're a registered investment advisor firm, and Wealth Enhancement has various subsidiary companies that we can utilize to have integrated resources if people have a need for, in your case, insurance services, but maybe it's tax services, maybe it's trustee services. It could be all range of possible considerations. When there is a need for something beyond the scope of our primary focus, financial planning and portfolio management, there's a depth of resources that Wealth Enhancement as a large organization has coordinated the ability for us to find useful resources readily accessible that we can help clients navigate and make use of. And of course, if people have someone they like to use for their taxes or insurance or whatever, that's not a problem. We can work with their team. But when they don't have someone and they need to have some assistance, it's nice that Wealth Enhancement has put together this depth of resources for this integrated approach that people like to have the ability to have and the convenience of coordinating through one organization, that they can kind of navigate all of their range of needs that they might have. So that's the goal. Try to make life easy for the client, but and not to overlook important areas. And risk management, which really insurance is fundamentally about, is a really important part of the building blocks that we think about when we talk about financial planning. However, Joe, one of the things that we were thinking about, our clientele, retirees, oftentimes people in or near retirement, oftentimes they start thinking, well, I don't need insurance at this stage of my life, which is often the case. They've created wealth, and the goal of insurance maybe at a different stage of life is wealth creation in the event that I don't live long enough to do that, or if I have a disability, or you mentioned various areas of coverage, but
Sure.
That it's oftentimes thought of as a wealth creation tool to, if I'm not able to do it myself. Now, when we get to a certain stage of life, maybe we have some wealth, but there still can be times when there are applications for insurance that can be a really great use. And we thought we'd talk about a few of those for people to be mindful of as they get approaching those issues of in or near retirement, when they might find this would be a great time to think about a use of insurance. And Jeff and I were kind of brainstorming before you jumped on with us. And, I think the first one that we were thinking about is people going through decisions around pensions and the notion of, on the one hand, the pension gives you the possibility of maybe a lump sum or maybe an income stream for life. And in many cases, people like the idea of a guarantee of an income stream for life, but they have this possibility they want their spouse to be considered as well. But what if I don't live long enough? Or what if we don't live long enough? Sometimes people look to this concept of called pension maximization, a technique to basically think about maybe the use of life insurance as a tool to maximize your benefits, but also make sure some of that wealth stays with your family after you're gone in case you don't live as long as you'd like. Do you want to talk a little bit about that topic?
Yeah, so we often refer to this planning opportunity as a pension max strategy. That's common in the insurance industry. When you have a retiree closing in on that retirement age, and they then are meeting with their benefits coordinator and their, how to choose their pension, whether it's going to be a single life, whether they're going to do joint survivorship. There's joint survivorship with percentages, 50%, 100%. So that decision starts to come into play as they near retirement. And just like you said, if they decide to take a single life pension, therefore the spouse not getting any benefits if that pensioner passes away early, that single life ends with the single life retiree, right?
Yeah.
But if they have life insurance to help supplement the surviving spouse, that single life pension typically pays 25-30% more than a joint life, say 50% survivor. So the calculation that's done for someone considering retirement that has a pension, a defined benefit pension that they get to choose, think of state employees, federal employees. There's not a lot of private pensions out there.
Not as many as there used anymore. To be. Yeah,
usually it's public servants, civil service that still has some pensions, teachers, police officers, things along those lines. But the calculation that we do within the insurance department is what's the single life versus the joint life, what you would typically choose, 50%, 100%, right?
Yeah.
And then we compare that difference, and if they could afford to buy life insurance and if it makes sense. And obviously,
just think about it for a second, Joe. If you were saying, just for simplicity, if it was like, oh, it's $1,000 a month if I take it myself, but $850 a month if I include my spouse for whatever that amount might be.
Yep.
If we were to put a name to that kind of a differential in another circumstance where you said, oh, I'm going to spend about $150 a month to make sure my spouse, my wife, my husband, retains an income stream after I've died, we'd put a name to that and call it life insurance, right? If you said, oh, I'm going to spend a premium and have a death benefit in effect, right? That's essentially all you're talking about when it comes to this notion. But the idea, if you live, and if you have a situation where, let's say, the pensioner lives a long time and then the spouse becomes the beneficiary, if it's built into the pension, we might never see the benefit of that because the spouse might not live a long time, and the heirs might give up a lot of that wealth in that scenario. Whereas if we did this privately through an insurance policy, we might be better served to be able to retain wealth intergenerationally. Now, there are differences in tax treatments, and there's a lot of variables. Sometimes there's differences in the benefits, like health insurance for the spouse or things. There's things to be tuned into that you have to look at and be mindful of. But oftentimes it can really work out nicely if your goal is to try to retain wealth intergenerationally. Would you say that's a fair characterization?
I would, yes, and I would say that the planning opportunities shouldn't start when you're 6 months away from retirement, right? This should be talked about 5 years at a minimum, because for the pricing to work for that retiree, they should have probably already bought their insurance a few years prior to the retirement age.
Well,
right?
of course, with a pension, you don't have to show you're healthy, right? But with a life insurance policy, you have to be at least insurable.
Exactly.
And, the earlier you do that, maybe the greater likelihood of, not having existing health issues get in the way.
Right. So something I like to talk to advisors and their clients about, especially with those pensioners, is buy a 10-year option to make that decision. What do I mean by that? If you bought at 55 a 10-year convertible term policy, let's just say is $1 million. You're 55 years old, 10-year term, and it costs, for that 10-year term, it's going to cost, I don't know, $1,000 a year, right?
Yeah.
I might be lowballing a little. Maybe it's $2,000 a year,
anyway,
right?
Whatever it is.
But you're 55. You're in your prime earning years. You're still healthy enough. You're an empty nester. You could probably afford the $2,000 to buy the $1 million option, right? I'm calling it an option because it's convertible. Now, if you plan on retiring somewhere between 62, 65, guess what? I locked your health in at 55. And when you say, you know what? I'm getting these pension reports, and now I need to start thinking about how I'm going to choose my pension when I retire. Let me consider converting that $1 million to permanent insurance, or some of it to permanent and leave the rest in term. Whatever that is, you need to then figure out, is it enough to cover what you would have gotten by taking a survivorship benefit, right?
Yeah, great.
So the survivorship calculation, a lot of pensions are pretty rich for the survivor. 50% of a $5,000 a month benefit, that's that adds up to be a $30,000 income a year. You need a significant lump sum of money in order to provide a spouse $30,000 a year income, right? So you have to have that calculation done in order to back into how much insurance you should probably have. And the insurance doesn't have to be all permanent insurance. Ideally it is, but you could level.
Yeah, I'd like to talk about that for a minute. I think it's a common mistake, though, that sometimes people say, oh, I'm going to get 20-year term insurance. And then, the problem becomes they live 20 years and the survivor is in a bind when there's not sufficient resources. So, I think it's a mistake to rely too heavily on term insurance as the resource for this. Your point is you can do it as a staged kind of approach. Maybe as you get older, the need for, let's just talk about how that lump sum is calculated. Essentially, conceptually, think of it this way. If I die at, I'm the pensioner, I get my pension option and I want to plan for day one. I've accepted my income and then I die in a car accident on the way home. Right. I need enough of a lump sum in this insurance to make sure that my spouse can essentially replace the income we were planning for, 100%, 50%, whatever that number is going to be. So the way we would typically think about that is like, what would it cost to buy an annuity to accomplish that? Gives us a value of how much insurance do we need as an essence.
Exactly. Yep.
Now, in reality, we may not choose to use an annuity when the time comes, but it gives us the way to know how much would we need if we wanted an absolute, a guarantee of being able to meet those needs.
Mm-hmm.
Now, in reality, we're probably not going to die on the way home from signing those papers, and so it's very likely we're going to live a lot longer. And so when the time comes that we have that death of the pensioner, we've got some choices. Now, we certainly could use an annuity as a way to guarantee that income for the surviving spouse. But if it's later in life, we probably wouldn't want to, because we want to keep that cash in the family and available. But you've got these choices along the way that you can navigate what's the best plan at a given moment in time. And you want to be in a situation where there's this insurance exists when it's needed. And that's why a permanent product of some type or something with a guaranteed death benefit to me, is the way we want to structure this kind of a circumstance for the bulk of it, at least. As you said, as if we think about it, we're willing to give up some of that wealth because now we live 20 years. Maybe some portion of term is very, is viable, where you can say, oh, well, there's still a portion that's going to be available for that survivor or for the next generation. Is that essentially where you're going with that?
Yeah, I mean, the biggest risk is those early years right after retirement, right? If you take the single life pension, those first 10 years are the most critical that you need to outlive. If you die prematurely, then you're going to need a big lump sum to cover and support the surviving spouse. Layering in some shorter term will make it, look much better for that retiring couple to be able to pick the single life. You're still going to need some permanent insurance to last out, for the long term. God forbid you pass away in your early 80s, but your spouse lives to their late 90s, right? So there's going to be a gap there that you definitely need that permanent insurance to last beyond, age 75, like a typical term would last till. So there's a calculation to be done, right? And a comparison. And
it
the
does
money
take
that
some planning, as you
yeah,
said.
and the extra money that you're getting from the single life pension, you have to factor into how much is going to go to taxes, and then what's your net after tax, extra that you're earning, and is that enough to pay for the insurance and still have some extra money? The idea is that you don't just, zero out when it's said and done. You want to be earning more income off the single life pension after the premiums are paid, after taxes are paid, so that you're actually making out better
Benefiting
than in
from
taking a joint survivor benefit.
Yeah, if it's equivalent, maybe it'd just be easier to use the pension. Yeah.
Exactly. Yep.
I think it's also worth thinking about. People today have maybe money that's in the bank that's kind of safety money, but isn't producing a lot. And it's sometimes appealing to say, take some of that money, put it into this product, because it's going to give you a much bigger income, cash flow, and you might not have to put as much toward the premium. It can really help generate more off of that savings as over a lifetime. That
Certainly.
it can really be worth thinking about. Well, this is just one thing that we mentioned for people in or near retirement. Pension maximization, very specific to people who have pension. But if you're in that scenario, it's really worth digging into the numbers and giving some thought to, particularly if you like the idea of the guaranteed lifetime income kind of a structure that this can be framed around. Jeff, we had other topics we were thinking about.
Oh, I'm still scarred from this conversation. Chris knows this, but Joe doesn't. I served on the Massachusetts Public Service Committee for a number of years, and part of that committee's role was to hear appeals from pension issues.
Yeah.
And a common one was the older widow coming in before us trying to make a case why her husband's choice, I'm stereotyping, could be any gender, but why her husband's choice of a single life should be undone. And we talk about it's probably not going to happen. You get killed the day after you sign your paper for your pension, but it does happen. Or a diagnosis happens a month later and the people are trying to undo it. So, we all think that these things aren't going to happen to us. I'm healthy, I'm strong, I'm going to pick the single life. Maybe my spouse's health isn't all that good, so it makes sense not to do a survivor benefit. But that's just, that's just like making a best guess. These things do happen, and this decision here of what pension option to pick and whether or not to protect yourself with additional life insurance is it's the most important decision you're making when you're, in this case, a public employee or someone with a pension, and you're making that decision. How should I structure this? And Joe, I love your idea of preempting some of this risk by getting the policy with the option, 10 years or so in advance of retiring, because that just, you can get rid of the policy after 10 years if you don't want it. But a lot happens with your health between age 55 and 65 for a lot of people.
Certainly.
So
Very true.
that's a great takeaway.
Yep.
Well, I was thinking one of the other things that people often think about as an insurance, with the use of life insurance in or near retirement, relates to trying to mitigate the risks of long-term care. And sometimes people get a long-term care policy, but it seems more frequent today that people use some kind of a hybrid policy that involves a life insurance structure that can give them some long-term care features that can help manage some of those costs. Joe, is that probably, I mean, we used to think estate planning, and we'll talk about that next, but we used to think estate planning was the primary reason people would get life insurance in retirement. But I think this probably is more common today. Would you agree?
Yeah, actually, the long-term care conversation has become more and more popular. We all know, baby boomer generation, 10,000 baby boomers turning 65 every day. Um, when you think about it, most of us have a story about a loved one having been in a nursing home or needing care at home of some sort, right? So we've all touched and felt a long-term care event in our personal lives.
Yeah.
And to be honest, I think when we talk about long-term care as a department with our advisors, um, it's usually a conversation that's brought up by the client, not the advisor. So we need to turn that around. We need advisors at Wealth Enhancement to talk more about long-term care planning. I think a lot of advisors might default to self-insuring because the clients are successful and have a few $1 million, so they think that they could weather the storm of a $150,000 3-year event, right? What happens if it's a 10-year event, right?
Yeah.
Dementia, Alzheimer's, those diagnoses can last for a decade where you're taking care of that individual. And if you go into a nursing home for dementia or some type of mental health issue, or cognitive issue,
Right.
it's twice as expensive. So talking about how life insurance has evolved in the long-term care space is really important. The traditional LTC product, think the Genworths, the John Hancocks, the MetLifes of the world, that sold a lot of product in the 80s, 90s, even 2000s. A lot of those products, our clients get letters saying, oh, the rates are going up, right?
Right.
And because those products are built on a health insurance chassis product wise, so they could go to the state commissioners and ask for rate increases, just like our medical insurance goes up regularly every year, right? So as long as they do it to the whole class of policy owners, they could raise rates, right? They might not get the 100% rate increase that they ask, but the states are often increasing 20, 30% increases, right? So that traditional product has pretty much fallen out of favor for most advisors and clients because the rates aren't guaranteed. About 20 years ago, Lincoln came out with a product called MoneyGuard, and this product was built on a life insurance chassis. This product was designed where it had guaranteed rate, and it was more often used as a single pay. So someone would put a lump sum of money in, let's call it $50,000, and they would buy $250,000 worth of long-term care benefit pool, right? So that product came out and Lincoln sold it like hotcakes. It became very, very popular, even though it was a single pay design only. Well, more and more carriers got into this life insurance hybrid space of designing products similar to that one. So now we have a dozen carriers that offer these types of products, and they've changed from just a single pay design to a 5 pay to a 10 pay to even pay all years, right? And so those products are by far the most popular design for LTC. And it also comes with the benefit of a death benefit because it's a life insurance contract. So you put in a lump sum or you pay it out over 10 years in premiums, guaranteed premiums again, and you're usually getting 3 to 6 times leverage on your money, depending on how early you're buying it. So the ideal clients are your clients between ages 50 and 70 that should really be having this long-term care conversation. And these linked benefit products, as we call them, or hybrid life insurance products, really do hit home on the needs planning for LTC. Usually $100,000 can turn into $900,000 of benefit pool by the time you're age 80, 85, right? So if you start in your mid 50s and buy a product with a single pay or 10 pay design, by the time you get into your mid to late 80s, it's a meaningful amount of insurance that all pays out from the insurance company tax-free, income tax-free. So that $800,000-900,000 benefit pool is coming to you to help pay for your care in those, those years that you need it, helping preserve assets for your loved ones, your spouse, whoever, right? And then on top of that hybrid design, you could buy a traditional life insurance policy. Just think your run-of-the-mill universal life or even whole life products that are out there, and add what we call accelerated benefit riders or LTC feature to them. So for a little added cost, you add the rider to it. So now you bought $1 million death benefit. You bought it primarily for legacy purposes. You're buying a permanent life insurance policy. You want to leave this to your loved ones. You add the rider. Usually the riders either come with a 2% or 4% feature, 2% monthly from the death benefit. So 2% every month from a $1 million death benefit is $20,000 a month, tax-free. So you're essentially drawing down your death benefit to help pay for your care while you're alive. And anything that you don't use from the death benefit when you pass away goes to your beneficiaries. So those are the real two big changes in the LTC space. The two life insurance products from a hybrid or what we call linked benefit versus the life insurance with, the LTC riders or accelerated benefit riders.
Well, you've given us like a 5-10 minute view of that right here, but would you come back sometime and let's talk about that on a show on its own?
Sure.
Because I think that could be a lengthy insight that I think a lot of people would like to gather. How do I manage this risk? As you said, I think a lot of times we think, well, maybe you can self-insure or, put a sinking fund or, you can have sort of a game plan where you can afford it. But as you said, you never know how things play out. And there might be some virtue to having insight as to how these products work. I think a lot of times we look into this and think, well, it's pretty expensive. And our clientele are generally inclined to be like, I don't want that. And we delude ourselves saying, I just won't have that problem.
Well, they're not going to use it, so they don't want it, right?
I'll leave you with these two comments about that perfect timing, right? So most clients that purchase, I'm saying more than 50% of the purchases on long-term care products are done emotionally because they had a loved one that went through it and they realized how taxing it was on the family, both emotionally and financially. So they don't really care. They don't care the cost. They'll find a way to pay for it. They don't want to be a burden on their children like their parents or grandparents were on their prior, right ahead of them. So they're buying it emotionally. Now, as financial advisors, we have to make sure it makes financial sense, that it fits in the plan, right? The second thing I'll say is that our clients are successful because they've been very diligent, responsible. They saved. They took your advice on how to manage their investments to get to their goals. They've become successfully financially, right? So all these years, they've made responsible financial decisions. Now, here they are at age 60, about to retire, and we're telling them the fiscally responsible thing would be to protect your assets with some long-term care insurance that we could get leverage of 5-8 times what you put into it premium-wise and get back tax-free. All of that makes complete financial sense. From a tax efficiency, leverage standpoint, makes complete sense. But because that client might have a net worth of $3 million, we as advisors say, oh, you can self-insure and just close the book and don't talk about it. So they're financially responsible. You've helped them be financially responsible. And now we're at a decision point to maybe add some extra responsibility or protection. And it costs too much money. There's value there. The value has to
be, and especially with this kind of product where you say, irrespective of whether you have this need, there's a payout of some sort. There's going to be money coming back to you.
Benefit coming back. Yep.
That can, because I think that's one of the challenges people think about with the traditional long-term care policy is, well, I hope never to use it. What if I don't use it?
Right. And the common objection is that the premium's not stable, and they've heard from their friends or their family seeing that rise in premiums, and they're afraid they won't be able to afford it when they actually need it.
Yeah, you start Googling long-term care pros and cons. The big cons start, there's lots of, articles written about the rising cost of long-term care products.
Right, but
We didn't
single
really
premium,
Sorry, Jeff, what?
single premium solution type solves that.
That does seem like it makes sense. Well, and every situation is different, right? So we've got to look at the context. One of the things we didn't really talk about, but I'll just, throw out briefly, and Joe, if you want to comment, feel free. But, another time, we used to think in terms of estate planning as a topic for life insurance. Today, the estate tax is relatively a high threshold. So it's not necessarily the estate tax that people need to be thinking about, but there are still instances. Well, in our case, I live in Massachusetts. Massachusetts has a estate tax after $2 million. So that's one, it's not the federal estate tax, but it might be a state estate tax. But there's also issues of liquidity or illiquidity. If I own a business, if I own real estate, I might not have the ease of liquidating assets in a timely fashion after the passing of someone who, has this wealth. There may be a desire to create liquidity along the way. Maybe it's like, oh, I want to keep this house or this business in
This farm,
place, but I want to also have equity for other kids. So I'm going to give them cash, but I don't have that cash readily accessible. You have different kind of scenarios that can emerge. And, we didn't even talk about business applications of life insurance, which are, again, its own show sometime. But this was great, Joe. We touched on a lot. Anything you want to last, thoughts or comments?
Yeah. And, you're touching on the estate planning. I say every client needs an estate plan. Not every client needs an estate tax plan, right? But if you think about what happens at end of life, is the titling of your assets right? Are all the beneficiaries named properly? Do you have a living will, a pour over? What happens at the end of life? Life insurance is instant liquidity, tax-free to your family to use as they see fit, right? And whoever the named beneficiaries are. You put it in a trust, it's outside of the estate, but the trust then dictates how it gets dispersed. I would say this about permanent life insurance or that using life insurance and estate planning. We have assets that are typically not really friendly to being, bequested to our loved ones. For instance, IRA qualified accounts.
Yeah.
Worst asset to leave to your loved ones, right? Another asset, non-qualified annuities. You pay taxes on all the built up gains in a non-qualified annuity. So there's ways to start changing those asset classes by maybe liquidating out of them and buying a permanent life insurance policy that you leave to your loved ones as your legacy. I know this too from my experience over 20 years in the insurance industry. Clients that own permanent life insurance and have that legacy check box off, saying, I already have taken care of it. I have a second to die policy and a trust. That's what I'm leaving my children. They feel more inclined to use their money that they've saved up and are using in retirement, as opposed to always having to worry about, am I going to run out of money? They've already taken care of the legacy side. They're going to take those children and grandchildren on the 2-week cruise to the Caribbean or to Disney World on the big family, reunion, because they feel comfortable spending their money because they're already taken care of it. So it's a permission slip to actually spend your money and enjoy life.
Ding, you used the magic word.
That's my favorite word, permission.
Yep.
And that's a great point. So by having that insurance in place, as in that maybe irrevocable life insurance trust or part of their estate plan, that they've put this money aside, that's for the next generation. They've planned for it, but it gives them permission to use their resources. And then that can be in shared experiences. All these that was a great example you gave, Joe.
It is. Awesome. That's an excellent point.
This was a great discussion. I don't know if you want to, but you're going to have to come back.
Let me know.
We barely scratched the surface. That was a great conversation. Thanks so much. We'll look forward to having you back and talk more. Until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll-free at 866-771-1020. 8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.